We'll check. Buongiorno, good afternoon. My name is Luca Testoni. I'm the director, editor-in-chief of Ethica News and ESG Business Review, and I'm the founder of Salone.SRI. So good afternoon. This is the first conference in the afternoon. Thanks to be with us for people in the room, and also for people that is following us through our platform, streaming platform. I'm here for speaking about the items of our conference, a new level of transparency in the climate debate. I think that it's a very good headline for a conference. It was a very lucky choice for us to have Salone.SRI today, 2 days after the end of COP26 in Glasgow. And because COP26 has just ended with many commitments and promises, and the problem was evident. Turning these commitments and promises into investments, the tools and strategies is much more difficult than it may seem. In this conference we will explore the key aspect to start with. I mean, knowledge of the net zero problem. It's important to know how much finance can do, but also how far we are now. So I'm here today for speaking about this item, so the new level of transparency in the climate debate, with Guido Gese. I have the pleasure to greet him, Executive Director, Applied Equity Research of MSCI. Hi, Guido. It's always very nice to meet you also if we are by video. With Mark Wade, Head of Sustainability Research and Stewardship Alliance Global Investors, and Willem Keogh, Head of Passive and ETF Investment Analytics Executive Director, UBS Asset Management. So the topic of the conference is not easy, but I'm sure that Guido will explain it at the best ways possible, because Guido is a very good relator, and a part of his knowledge that probably is one of the most important in the sector is also very able to make easier the topic. Okay, Guido, it's a pleasure for me to give you the stage for your introduction and presentation.
Thank you, Luca, for the introduction. I hope you can see my screen. Otherwise, please shout. But my name is Guido Gese. I'm heading the climate and ESG solutions research at MSCI in London, and I would like to briefly give you a brief overview of the question: what can investors do to drive the net zero race of the real economy? The reason for asking this question is that I've been in Glasgow personally 2 weeks ago, and everybody talks about net zero investing, $1 trillion here, trillion there. But then there are also some very skeptical people. I read some articles in the Financial Times saying that, oh, you know, this net zero investing is just a marketing gadget. It doesn't fulfill any real purpose. It's a placebo, some people say, and say, okay, you know, there's some critical questions in the room. Let's address them. What can investors do to have a real impact on the race to net zero of the economy? And let's start with a clear scientific definition. What is net zero? So net zero means obviously the economy needs to decarbonize so that the world is net zero emissions in about 30 years. But what is more important is the world needs to stay in a remaining emission budget. So to limit global warming to 2 degrees, we have a remaining emission budget that we can put in the atmosphere. And the lower the temperature we want to reach, the tighter the budget. So 1.5 warming requires a tighter budget, so less emissions go in the atmosphere. The same holds for your portfolio. So basically the companies in your portfolio need to reach net zero, but more importantly, they need to stay within their fair share of the remaining emission budget. So it's really about managing the remaining emission budget. It's similar to the problem of a finance minister, right? Finance minister, they need to manage a monetary budget. The world needs to manage a remaining emission budget. And basically, as a portfolio manager, you want to make sure that the companies in your portfolio stay within the remaining budget that represents their fair share. That's what net zero investing means. Manage the remaining budget. So remaining budget is a management tool for governments, for portfolio managers, and for companies. And that's why at MSCI we started measuring remaining emission budgets. So we take the global remaining emission budgets that IPCC estimates, we break it down into country sectors, and we calculate a remaining emission budget for every company in the listed equity world. So, and that enables people to manage and control these budgets, right? And we make it very transparent on our website. On our website, we show this cent clock. And this is the remaining emission budget of MSCI ACWI IMI companies. These are 9,000 listed companies. And as of October, the remaining emission budget of these 9,000 companies, so their fair share, is 230 gigatons in CO2 equivalent. If we want to reach a 1.5 world, they only have 58 gigatons left. That's a very tight number, especially when you look at the sand going through. The sand is what we spend every year. So companies in ACWI IMI, they put 11 gigatons of emissions into the atmosphere every year. And we have 58 gigatons left. So that gives you a sense of urgency. We are spending the remaining emission budget to limit global warming very rapidly at the moment. Unfortunately, I have no better news than that. It is what it is, and we update the figures in our ACWI tracker on our website regularly, so you can see the sand going through the clock in life. Now, here comes the big question: what can investors really do to drive the decarbonization of the economy, basically to manage these budgets? And here, as I mentioned before, there are some people in the market saying, look, investors don't have a role to play, right? It's just a placebo. Let's look at this argument, right? Let's look at this argument, because from where we are today, the world could go into two very different directions. A pessimistic one and an optimistic one. Let's look at the pessimistic on the left-hand side. So what I illustrated here is the cross-sectional footprint of global investment markets, right? So you have some brown color, which is high emitters. You have some green color, which is low emitters. And in the pessimistic world, the market, which is the blue line, does not decarbonize. It doesn't. So the world stays dirty. But net zero investors, you know, they reshuffle their portfolios, they make the portfolios look green. So the net zero portfolios, they go to net zero, but the market doesn't. So then as an investor, I have a green portfolio in a dirty world. Well, what's the point of that? Seriously. I mean, that doesn't sound right, does it? That doesn't sound like a real purpose of net zero investing. Now, then there is an optimistic scenario. I call it the convergence scenario. Here, investors drive change. So investors shift capital from climate laggards to leaders. Thereby, they shift the cost of capital in favor of companies that are willing to change, and they penalize companies that don't want to change. They use voting and engagement as a stick, right, on companies that don't decarbonize, and ultimately they help drive convergence. So all companies should drive to net zero. So basically here, they use the typical carrot and stick, right? Reward the leaders and take the hit the laggards with the stick. So to drive everybody to net zero. So in this world, the behavior of investors would help drive the real economy. Now, this is now, of course, the to be or not to be question. What are the economic levers, the drivers that investors can use to drive real convergence, right? And not just be, you know, a placebo effect. What are the economic levers? What is the carrot and the stick they can use for companies? Now, and here I just summarize what academics say, IMF say, and so on, but also the net zero asset owner, net zero asset manager alliance. Basically, roughly speaking, there are four economic levers investors can pull. One is, of course, the decarbonization, which means a shift in capital towards leaders. So basically, the first lever is finance the leaders. But who are the leaders? Are they the green companies? No, they're not necessarily. So leaders are companies that are willing to decarbonize their business model, and they need capital to do that. I mean, you can't shift your business model without fresh capital in many situations. Or these are companies that build technology that helps others to decarbonize. So leaders, they decarbonize or help others to do so. These are the leaders. Finance them. That's the first economic lever you can pull. The second one, voting engagement. So as a shareholder, you have a vote, you have a voice. Use it. If there are companies in your portfolio that don't want to decarbonize, go after them. Make sure they hear your voice. The third lever is, if voting engagement really fails, you can divest from companies, right? I mean, every company needs capital to operate. If you cut them from capital supply, you don't provide loans to them, you don't buy their equity, you don't buy their bonds, they're cut off capital supply. They can't operate without capital. That's a very painful thing to do. And that's exactly what it should be if companies don't want to take climate seriously, right? And the fourth economic lever is support governments and policies, because investors and companies can't solve the problem themselves. So governments need to help, especially to go after the free riders, right? Because historically, emissions were a free riders game. Everybody could free ride on emissions. We can't do that anymore. We can't have free riders in the economy that continue free riding in emissions and not doing anything. So, of course, investors can come after them with their shareholder vote, but governments need to do the same, right? So support governments in establishing policy. So these are the four economic levers. The key question is, do they work in practice? So do we see that shift in capital, for example, really changes cost of capital valuation level? Is there this incentivizing effect in the economy by investors using the carrot and the stick, right? We looked at that. So we published a research paper, which is a little bit technical. So I don't want to be too technical today. I just summarize you some observations, but you can dive into the research paper. It's full of charts and simulations. But basically what we did in our global benchmark, we compared climate leaders, so companies that are early movers into green technology, to climate laggards that are heavily fossil fuel based in each sector. And we control for all other factors. And we asked the question, do we see a market implied shift in cost of capital, valuation level, earnings growth, and so on, that would indicate that this incentivizing effect works? The funny thing is, until 5 years ago, there was no effect. So until 5 years ago, in global equity markets, the markets were agnostic to the climate profile of companies completely. But 3-4 years ago, we saw a trend emerge. We saw suddenly that companies that were early movers in green technology, they saw their cost of capital go down relative to the carbon intense peers. We saw their valuation levels increase, while the valuation levels of carbon intense companies went down. We also saw a stock price outperformance. But the most important thing, I would say, the most important finding was that the early movers into green technology had an earnings growth advantage. Because as a long-term investor, you look for earnings growth. And here on the left-hand side, I show you the energy sector. The earnings growth of climate leaders in the energy sector to climate laggards, defined as who has more investments in green technology. And we found that in the energy sector, early movers into green tech had better earnings growth and better share performance. So that means financing the transition makes economic sense, because that's where future earnings sit, right? It makes sense to finance the transition because there's more future revenues to make. And this also means it doesn't make sense to say, look, I divest from the energy sector entirely, because you may miss some opportunity, right? The early movers in the energy sector, they have been more profitable and growing faster. Now, there is a drawback here, unfortunately. These effects that we found, they were very much located in pockets of the portfolio, the energy sector, utilities, and in developed markets. But to really drive change, investors need to scale up. We need to see these effects, the shift in cost of capital, shift in earnings across all sectors and in emerging markets as well. And here we need to say, investors need to do more. They need to scale up these effects, because what we've seen so far is the world hasn't really decarbonized. When we look at the emission history of the world or the emission history of global equity markets, they look the same actually. They look like this. We haven't seen a big decarbonization. We've seen a drop in 2020 because of COVID, but we now see emissions are picking up again. So investors need to do more. Investors have a lever, but they need to use it consistently across their universe. And the next question is now, I summarized a bit the theoretical arguments, the theoretical findings, but what's the best way to implement it, right? Because everybody talks about decarbonization and decarbonizing by 7%, 8%, what's the right number? Well, what's the best way to do this to drive real change? And there are basically two ways you can decarbonize a portfolio to drive change. It's important to understand the difference between the two. And I'll explain it very high level. So it really works for an equity portfolio, bond portfolio, or a loan portfolio. There are two basic approaches. The first basic approach is you just improve the carbon footprint. So here again, I plotted the cross-sectional carbon footprint. You know, the colors indicate different levels of emission intensity. And then you can decarbonize your portfolio, whether it's a loan portfolio or equity portfolio, by frequently rebalancing towards lower emitters. So you get rid of high emitters and you tilt towards lower emitters. So you improve the carbon footprint. Now, this is very simple. This is how climate investing started. You only need carbon footprint data. It's very effective, very easy. However, you may ask the question, is that really the optimal alignment? Because if you want to finance the transition, you may hold on to some high emitters if they decarbonize, right? Why would you sell a high emitter if the high emitter does the right thing and really decarbonizes? So you might ask the question, is there a more forward-looking way to decarbonize my portfolio, to invest in decarbonization leaders rather than just selling the high emitters and buying the low emitters? Because that's more naturally aligned with the idea of financing the transition. And that is possible, and that looks like this. So in this one, in this approach, and again, it works for equity portfolio, for loan portfolio, here you don't rebalance your portfolio towards lower emitters. Here you rebalance your portfolio towards emission improvers. So you're holding on to many companies, even some high emitters, but you always hold those high emitters that decarbonize, that do the right thing, right? Their emissions go down. So you tilt your portfolios towards lower emitters, which is more aligned with naturally aligned with the idea, finance the transition. But here the question is, how do you do that? Because here you need kind of a forward-looking assessment of who are the decarbonization leaders, who are the ones that change their business models, that set targets, that want to go to net zero. So because it's not about carbon footprint here. Here is really about who are the improvers. And here, I think it's important to highlight that the TCFD has put out some suggestions, and I think the most important suggestion is to come to a forward-looking assessment who is managing their emission budgets well. And TCFD proposed to use a measure called implied temperature rise, which measures which companies align themselves very well with the decarbonization target. And here it's very simple. I just give you an example comparing Royal Dutch Shell to ExxonMobil. And they are both oil companies, so you can imagine their emissions are high. You see them on the y-axis. They're both high emitters, but there's an important difference. Now, Royal Dutch Shell committed to decarbonize. In fact, they were forced by a Dutch court. You know that. You might have read that in the news, that they need to decarbonize quickly. So what you see is the gray area is their remaining emission budget. This is the fair share of the world's emission budgets Royal Dutch Shell has. And their projected emissions, so what they promised, because they were forced by a Dutch court, is they will manage it their emissions closely to the budget. So that's why we are saying their temperature is closely aligned with a 2-degree target, because they will manage their decarbonization within their budget. By contrast, Exxon doesn't seem to decarbonize, and they don't put out targets. They seem to go on as ever, which means they will end up most likely with a huge budget overshoot. So their remaining emission budget, they will overshoot it dramatically. And that's why we attribute a temperature 4 degrees. So basically this implied temperature rise basically tells you who is managing their remaining emission budget well, and who isn't, right? It's a management tool. It might be worth doing a similar thing for finance ministers and seeing which finance minister manages their budgets and giving them a temperature, right? Would be funny to see what comes out of that. But here we do that for companies to see who is managing their budgets well or expected to manage it well. And this gives investors a possibility to tilt their portfolios towards the aligners, the ones that manage their budgets well, rather than companies that just have low emissions today. There is one challenge here, though. When we look at how many companies are aligned with a low temperature at the moment, there are not so many. So our global benchmark, MSCI ACWI, 9,000 companies at the moment, the average temperature in the portfolio is 3 degrees, which means on average companies heavily overshoot the remaining emission budgets. So on average, companies do not manage their targets their emissions very well, and only 10% of ACWI, so 10% of 9,000 companies currently align with the 1.5 degree budget. So they seem to have a emission trajectory that most likely will hit their remaining emission budget. So that means, as an investor, if I want to build portfolios that are today aligned with a 1.5 degree world, I have a very small opportunity set. So only 10% of companies are aligned. So how can I build portfolios with 10% of the names in the benchmark? So here you might choose a combined approach. But I mean, a combined approach, what you can do is you decarbonize your portfolio over time by constantly balancing it, and you can do both. So you can tilt your portfolios towards emission improvers, so the ones that have aligned themselves with a right decarbonization target. And if that's not enough, you can overlay it with the second tilt towards low emitters. So you can play both simultaneously, tilt towards emission improvers, tilt towards low emitters, to in aggregate come to a right decarbonization target rate. So we can play both at the same time. This is, by the way, how our Paris-aligned benchmark works. It has both components in there, tilting towards lower emitters, tilting towards companies that have targets and manage their carbon emission budgets. So this is a way that investors can finance real change, drive real change. And the key thing is, just to sum it up, I think there's clear empirical evidence that investors can drive change through their shareholder vote, through access to capital, through cost of capital. And these things are effective. We see it in the data, but investors need to scale up, and they need to scale up rapidly because the clock is ticking. So this is to remain in a 1.5 emission budget. Companies have 5 years and 3 months. So basically, if companies don't do anything, they emit as they are. In 5 years and 3 months, the companies in global equity markets will have exceeded their remaining emission budget. So it's time to act. So this is the overview I wanted to provide. And with that, I'll hand it back to Luca.
Thank you, Guido. I really like the passionate way of your speech. I think that it's a strong message regarding the way the finance can improve the world. I mean, can studies the world problems and can manage them and can offer instruments, tools to improve the situation. And so thank you for your presentation and also for the warning message of the watch, of the clock at the end of your presentation. Okay, now let's involve also Mark Wade, Head of Sustainability Research and Stewardship of Allianz Global Investors, and Willem Keogh, Head of Passive and ETF Investment Analytics, Executive Director, UBS Asset Management. Okay, guys, it's just a nice breaking question, very, very quick and short, just to open the discussion. And it's the same question for both of us. What do you think about two of the Guido's key points? I mean, finance's ability to act and not only to be a placebo effect. And the second is the importance of ranking the good guys and the bad guys.
Okay, thank you very much for that. And as a British man, British aren't renowned for passion, but I'll try and match Guido's as best as I can. I think finance has a huge role to play, both in terms of thinking about lowering emission footprints, but also in terms of facilitating the funding of solutions, or what you could call improving handprints. Different investors' perspectives on sustainability are being met by an evolving suite of products across asset classes, both public and private, across corporates and sovereigns. And these are actually facilitating what Guido was talking about in terms of his combined approach, which is, green to very green is great, but brown to olive to green is a necessity. So, when we think about identifying and using the data, it's useful to rank good versus bad, but we need to understand what the ranking actually represents and where we can achieve the greatest delta. So, the scoping of the ranking is important. I think if we look at net zero, I think it's a really interesting one, because one of the great things about COP26 was it started to capture the different constituent elements: climate scope 1 and 2 versus 3, CO2 versus methane, gross emissions versus net emissions. And also, we started to get into how the balance between E, S, and G. And governance is particularly in scope after COP26, because we need to turn pledges into practice, and we need to have an understanding of the binding nature of those commitments. Some of those are quantitative and some of those are qualitative. So I think, really here, I think, there's a massive role to play. Finance, there's an enormous amount of finance that's needed to achieve those goals, and it needs to be deployed in the right way. So I think, ranking good versus bad is one way of thinking it. Where can you achieve the greatest delta is probably where we need to be at the moment, and how we facilitate that.
Thank you, Mark. Willem, what's your talk about these items?
Thanks very much, Luca. Thanks, Guido and Mark, for the comments thus far. I think I can only echo that clearly finance has a very important role to play in the allocation of capital. I think when we consider the amount of work that is ahead of us to tackle climate change, I think it is really important to understand that finance will play a crucial role in ensuring an orderly transitioning from where the economies are today into what will be a more sustainable economy. And I think, as Guido alluded to, it's already clear to see that the cost of capital is already starting to have an impact. I think we also, if I look at it from a practical perspective, we can also see that there has been a shift from the investor base. So what we're seeing is that since essentially the beginning of 2020, we've seen a dramatic inflow into sustainable funds. In essence, to the point where we have witnessed that over the past 2 years, about half of all inflows into funds are now into sustainable funds. And yes, it started off at a low base of around 6% of AUM in the beginning of last year. Now it's already grown to 16%. So it's clear that there is a major shift, I would say even a tipping point that has been reached, in particular now where we have half of all inflows going into sustainable solutions. Now, if we look at leaders and laggards, from a practical perspective, again, I think it's really important to understand that one has to identify these companies very clearly, because it allows for the construction of very robust solutions. If we can identify which companies will be winners and losers, and be that from an ESG perspective, be it from a climate perspective, I think it's really important to then also have transparency. Now, Guido has mentioned about the ACWI tracker. I think this is really important. The clients can see and understand, or investors can see and understand what is happening and what is really required in the scale of the challenge that is lying ahead of us. But I think also important from our perspective as a fund manager is, transparent investment vehicles like ETFs are very important, because here your ultimate investor can have a look through into the holdings of what it is that what the fund is holding. And what we are seeing on a daily basis within my team is that we are getting more and more requests from clients and investors to understand why is company A included or company B excluded from a specific index. And then also trying to understand what are the reasons behind these exclusions, but also trying to understand more in terms of how that plays into the whole sustainability angle. So I would say the knowledge that we have seen in terms of sustainability has increased dramatically over the last couple of years in terms of understanding from our clients. Now, I think a final point here, again, to come back to the leaders and laggards and what Guido and Mark both alluded to, that it's not just so easy as to say, okay, let's just choose the best companies out there or the greenest companies, because you will end up with extremely concentrated portfolios. I think what we have seen over time in the experience that we've had together with MSCI when we were essentially the pioneers in the SRI methodology is that you can actually start and distinguish between leaders and laggards. So you can leave some laggards out. You can select, best-in-class solutions, for example. And over time, we've also seen with a 10-year track record now that essentially you don't have to choose always between returns and sustainability. I think hopefully this discussion has been buried over time now, that we don't need to look back and see whether sustainability brings performance. We know that this is actually the case. And we've again seen it play out during the COVID epidemic, where we've seen extremely strong performance from sustainable solutions vis-a-vis normal benchmarks. And I think this is very important to understand, because in times of stress, it is also natural for investors to go and look for leaders. And I think this is played out now time and again with every time when we've had a market upheaval.
Thank you. Thank you, Willem. Thank you, Mark. So, transparency, it's very important, and you remarked this importance. And ESG, its importance. And Mark is going to introduce another topic. Let's come back to Mark. It's not just ESG that we have to consider, or better, not just the E of ESG, but finance must also consider the S, social, of ESG. It means that the path to net zero does not only environmental implication, but it's important also social aspects. What do you expect in terms of just transition in 3, 4, 5 years?
Yeah, thank you for this, and this is something I feel very strongly about. The 30,000 feet view for us is, we have 3 key pillars here. Climate change, that's the temperature we will live in. Planetary boundaries, that's how we're going to sustain our lives in a higher temperature. And inclusive capitalism, how we're all going to coexist equitably in a higher temperature world. They're all interlinked and they're codependent. I think one of the sad elements was the social side of ESG has been very cruelly exposed by COVID. We saw healthcare divides, we saw digital divides, we saw financial access divides, we saw education divides. And when you saw about some of these social imbalances, it was very good to see it being visible in COP26. Even if we look at the last minute toning down of the COP26 agreement, that all came around because of the relationship of cheap energy through coal and how it facilitates the development agenda and poverty eradication. We question that, because if you're not targeting 1.5 degrees, you might actually put those 2 agenda items much more difficult to hit over the long term. So I think, the more you embed social issues into climate change, the less politicized, the less geopoliticized it can become. And it really is about, how we balance the E versus the S. I think this can be achieved now across the asset classes. Now we're beginning to see an increasing depth and breadth of use of proceeds bonds, the use of robust quantitative and qualitative approaches, and also thematics. So, for me, when we think about just transition and where we're going to be in the next 3 years, we're going to see a lot more thematics coming through, a lot more, and also much more specific KPI approaches. Let's take water as an example. In some regions, there is a direct battle between the population and industry over water. And the solution could be about being more efficient in your water usage. It can be about new technologies to maximize the availability to the fullest community. It can be about trying to reduce that water intensity. So when we're thinking about climate transition, can we also think about the impact on waste? We think about water. And it's interesting to see those elements, those two specific elements included in the PAI principles that are going to be much more relevant in regulation going forward. Then we think about climate. We've got a rising population. A rising population means rising calorie consumption requirements. And climate puts that at risk. So, if you've got that less predictability about the food supply, but rising demands, we need to think about the global food ecosystem, and does it need to be rewired? Rushak Sudak talked about the fact that the green finance needs to be rewired. Maybe the food ecosystem needs to be rewired. So, when I look at some of the funds, the Allianz Global Water Fund, we directly target topics like water supply, water efficiency, water quality. If you look at the Allianz Food Security Fund, we target a sustainable agriculture, food supply chain, nutrition. And I think it's thinking about not only the specificity of these social targets, but also the way they integrate with climate. That's going to be very important. If you achieve climate transition, but you put water and you put food at risk, ultimately you introduce uncertainty, geopolitical, community tensions, influences over that, and you ultimately are unlikely to achieve those goals. They come unstuck. So for me, I think that not only does it resonate with more and more increasingly with investors, and there's greater data capture there, but it is simply a key component of how we're going to achieve net zero. We can't achieve net zero without giving sort of much more credence to social claims than has been included in the past.
Thank you, Mark. So a very short question on the topic for Willem and Guido. How much this aspect, just transition aspect, are already within investors' analysis, and how much are they still a danger because they are difficult to estimate, to understand? Who is the first, Willem or Guido? Maybe Willem, because Willem will speak later.
Thanks very much, Luca. I think this is it's very well summarized, Mark. I think you've really drilled down to the hub of where we see the E and the S part intersecting, if I can call it that. I think, Luca, to answer your question, clearly, as investors are looking at adjusting their investment philosophies, I think it's becoming very hard to not look into these topics that Mark has mentioned. I think the past 2 years has been hard on everybody, and I think it's been clear that there is changes that is required. You can see from a lot of corporates that there is a lot more focus now on diversity, for example. So I think as we are seeing basically a change in the underlying market structure of how we're going to implement climate change, I think it is clear that there's going to be challenges, but there's also going to be opportunities. And this comes again to the point of, as we're seeing more data being required, more data being used in investment processes, I think there's new data sets that are coming online to basically help us enrich the data sets that we already have. And I think the more that these, let's say, social parts come out and is required by investors, I think you will see more and more qualitative, more quantitative data coming in. And I think these will definitely find its way into the investment solutions that will be built in the future. Now, clearly within thematics, there are already certain thematic funds that target certain of these aspects. But I fully agree with Mark that I can see that this would be something that would grow because there is investor demand, and I think it makes complete sense to make some of these investments.
Thank you, Willem. Guido, is this the same sunglass or the same warning watch for the social aspects?
Yeah, I think Mark touched on a really important issue, that climate risk has huge social risks, right? And we've just, as Mark said, we've just seen during the COVID crisis, right, that when disaster happened, social imbalances even increased, right? I mean, every country was fighting for themselves. Even in the EU, every country was fighting for themselves, right? The idea of working together, it disappeared very quickly when every government thought, what can I do for my people, right? So in social imbalances during COVID have increased. It's actually terrible. And that teaches a lesson of how we should not deal with the risk of climate change, because climate risk, of course, involves huge social risk, right? Because global warming is not uniform over the planet. There are certain regions that are especially at risk, where we have risk of droughts, increased risk of droughts, coastal flooding, extreme heat. And that means poverty, it means hunger, it means lack of water supply. And I think we should definitely not forget about these risks, because these are actually ultimately the reason why we should think about climate change, because these social risks will appear further down the line, and they will increase the social imbalances unless we manage them better than we did during COVID. And going to the practical aspect, what William said, clearly from an investor perspective, to assess these social risks, it requires new types of data sets that are very forward-looking long-term. Now, and that is very challenging. Clearly, MSCI is the largest provider of climate and ESG data, and we spend a lot of time and effort on that. So we started collecting a lot of data sets on where in the world do we see increased frequency and likelihood of droughts, of coastal flooding, of extreme weather conditions, and we track them over time. So in our data sets, you can see how these extreme weather conditions increase in locations. That gives you an idea where these risks, right, ultimately the risk of lack of food supply, lack of water supply, where they may appear in the future. But clearly, these are data sets that need to go very far, need to be very forward-looking, and it's a challenge for data providers and of course for asset managers who want to implement these data sets in portfolios. But fully agree to Mark's and William's comments. It's absolutely crucial to take these risks seriously, because they are probably the most important part of what climate risk is about.
Thank you, Guido. So let's turn the round table to another topics. Willem will speak. Will tell us the experience of UBS in terms of products and indices, especially from the point of view of duration by type and by geography of the clients. Which is your experience, Willem? I know there is differences relating to compliance, relating to geography, relating to complexity. Which is the situation?
Thanks very much, Luca. I think since we're talking about net zero today, it's really important that we also take a step back and recognize that regulation is starting to play an important part in all of our businesses. So if we look at what the European Commission have done over the past couple of years, creating the technical expert group, who then created basically the underlying structure of what has now been enshrined in law around Paris-aligned and climate transition benchmarks, it's really important to understand that from the first time, we are now seeing that regulators are putting down minimum standards in terms of what climate solutions should look like and what is required in terms of exclusions, for example. Now, this clearly has a bigger impact on the index provider side, but then also from the fund manager perspective, it's all about transparency again. So if we look at the Sustainable Finance Disclosure Regulation, we now have to classify ESG and climate solutions either in Article 8 or Article 9 And clearly with Paris-aligned benchmarks, this is classified under Article 9.3, which has a specific section dealing with it. The important part, I think, that we're seeing is that we have launched a very extensive family of Paris-aligned benchmarks, which are based on the MSCI Climate Paris-aligned indices, the flagship indices. And essentially, we've rolled this out across 7 different regions. But the important part here, again, is that we really need to understand from not only satisfying regulatory requirements, both from an index perspective and also from a fund manager perspective, but also where we go above and beyond it. Guido has previously mentioned the requirements or the recommendations from the TCFD. Now, these have all been taken into account when these indices have been constructed. And clearly here, we now have certain guidelines. So the carbon footprint of the portfolio is reduced by 50%. And essentially, the self-decarbonization of 10% per annum is kind of bringing these Paris-aligned benchmarks already to net zero by 2030, which is clearly very ambitious goals that we have. But again, if we look deeper into it and we understand, what is it that we are trying to do here with creating these 1.5 degree temperature pathway products, it's really important to step back, as we have mentioned throughout the entire discussion today. We again are identifying leaders and laggards. We are identifying companies that are setting targets. And I think this is really important to understand, because if you are in a business where, let's say, for example, a utility generates energy from burning coal versus a renewable energy producer, these are 2 very different companies and should be rated very differently. But then also, as Guido mentioned, depending on what these companies are doing in terms of setting their targets and how they are reducing their emissions, it's really important to keep track of that in order not to just have wholesale exclusion from all of your indices. But I think also another point that is touching on, as what Mark said before and what Guido also said in his previous answer, is we have to look wider in terms of where are we going to see major impacts from climate change. So flooding, droughts, these things are very important to understand, and this clearly has an impact on your portfolio. So what was very interesting for us is if you compare a Paris-aligned benchmark vis-a-vis a normal traditional benchmark, you can clearly see that there is a lot of hidden risk that you can capture with a climate value at risk, for example, and that you can then tilt and adjust your portfolio in such a way not to have exposure to these kind of risks that are clearly underlying and are there in your portfolio. So then I think in terms of looking at the different regions, we are seeing clearly, this has been a European collaboration within the European Commission to try and look at climate change. But I think what we're seeing is very interesting is that clients are looking at this as a global problem. We're seeing quite a lot of interest in some of the regions. So for example, in Japan, clients want to make investments into Japan, but they also want to start considering climate change and the impact that would have on a specific region. And I think these points are quite interesting for us to see how this market develops. Now, granted, within these Paris-aligned benchmarks, they're quite new. They've only been around for, let's say, a year and a half. We're slowly starting to see clients transitioning towards these. And it will be very interesting if we have this discussion in another years or 2 years' time to see what the uptake has been from clients and how much we have seen flows being directed from, let's say, more traditional benchmark or solutions more towards purely climate-focused solutions. So I think the performance that we've seen over time with these solutions have been strong across the various sectors and regions across the world. But I think in essence here again, if you have a product that will be 1.5 degree aligned by 2030 already, I think the investment case is kind of making itself, and it'll be interesting to see how quickly clients want to adapt and follow this road.
Thank you, Willem. Okay, we stay again on compliance. I'm curious to know what Guido and Mark think about the role of compliance in the path toward net zero? I mean, how much can compliance push, or on the contrary, how much can compliance slow? I mean, to make it more difficult to arrive to a net zero horizon. What do you think, Guido, about this matter, this problem?
Yeah, I think regulators and compliance has a huge role to play, and I also mentioned in my presentation, because the regulator can solve a problem investors and companies cannot solve, which means define common standards and go after the free riders. So that means for companies, it's important that minimal standards in terms of targets and also disclosure are defined. I mean, it's simply unacceptable that we still have large emitters today, so really large emitters, utilities, energy companies that don't disclose any carbon emissions. I mean, that's simply not acceptable, right? Especially for large emitters. So we need to have minimal standards, and the regulator is the only one that can force every individual company to do so. Same with targets, right? I mean, especially high emitters, they need to start thinking about their future, defining targets and manage the targets. So there's still many companies who are doing that, and clearly the pressure from the regulator would help a lot on the company side. Same on the investor side, right? I mean, investors, there we have the same issue, disclosure and defining minimum standards. So starting with how do we measure carbon emissions, how do we measure improvements, how do we classify benchmarks as Paris aligned or 2-degree aligned, 1.5 aligned. So here the regulator and the EU regulator has I think here a leading role, defining standards, defining classes and categories that everybody is using really helps to improve the transparency for the investment market. So yes, I think the regulator has an important role to play, both for companies and for investors.
Thank you, Mark.
Yeah, I'm going to just take a, follow on from that. To what norms are you trying to comply? AGI has been doing sustainable investing for over 20 years, and it's fascinating to see how norms have evolved over that period and will likely continue to evolve. And this will be impacted by evolving regulation. We need to recognize the intended and unintended consequences of accepted norms, whatever that means, and identify as best as possible a uniform approach for achieving these common goals. If we look at IFRS, look how long it took for it to become a norm, and we're trying to achieve a sustainable version of that in a fraction of that time. So regulation has a huge role to play, but it needs to be scalable, it needs to be relatable, and at its heart, complex solutions need simple solutions. And I think that's, it's interesting to see that all of those outside of Europe are really scrutinizing the progress and the challenges being made under European sustainability regulation to see to what extent it resonates or is problematic for other areas. And ultimately, we need a global green finance pathway somehow.
Okay. We are really on time, so we have the possibility also to a last very, very short question. Can we say that ESG is the tool that is progressively bring finance closer to the real economy? Is a question for all of you.
Okay, I'll start. I would reframe that question. If we, instead of ESG, we say non-financial. So if we look at combining, do I believe that combining financial and non-financial analysis into decision-making is going to become much more the norm and integrated, embedded into decision-making? Yes. If you look at the top 5 global risks identified each year by the World Economic Forum, in 2010, 4 of these were economic or financial. 5 of them are now non-financial. I think, so from my perspective, you're going to see sustainability with the data coming out, the breadth and depth of data and the capture. You're going to see it being hard-coded into financial decisions and modeling frameworks. I see a time when the way that a company or sector fits into the economy impacts terminal growth rate assumptions, margin assumptions, and weighted average discounts, weighted average cost of capital, to the points being made earlier. So yes. And lastly, from a risk perspective, you know, yesterday's 3 or 4 standard deviation events could be the future's base case.
Thank you, Mark. Now, Willem, what do you think about it?
I think that was well summarized, Mark. I think if we look at how sustainability, as I always loathe to use this, has gone from niche to mainstream, I think it's really clear that there is increased focus by investors. There is increased focus from regulators. And I would say if you have thoughtful regulation, that could really assist dramatically in terms of how companies behave and how investors behave. But we also have to understand that hopefully this transparency is also going to speed up transformation. And here this will really be driven by investors. I think we can see already some wins for investors in terms of how they have gotten certain people on the boards of energy companies, for example. But I think ultimately, as we have more transparency, we have thoughtful regulation, I'm quite optimistic that the steps that we can take then towards a more sustainable future hopefully can happen at a greater pace, because up until now, the change has been relatively slow, if we have to be quite honest, if we think back to what happened in Paris in 2015. Taking into account Guido's 5-year timer, you know, 5 years ago was COP20, so was the Paris alignment. So 5 years goes past very, very quickly. But I think in terms, again, to mention that I think finance is going to play a crucial role in facilitating this orderly transition from the current economic environment to a more sustainable economy.
Well, thank you. So Guido, it's up to you. You are the last to speak, and probably this is also the conclusion. What's about ESG and the real economy?
Yeah, no, first I agree with Mark's and William's comments that ESG is and will become an integrated part of financial management. I think the one thing is that what we should do in future as well is to measure the real effect of ESG, right? Because, I mean, we're talking about net zero alignment, but I think now in the next years, and going back to William's point, that we haven't seen enough decarbonization. I think now it's time that we use also our ESG data knowledge to hold companies accountable, to measure real progress, and where it doesn't materialize, to go after these companies and basically drive a change in behavior, because that's ultimately one of the purpose of ESG investing, is to drive real change. And we have the data, but we need to monitor it and go after the companies where we see a lack of progress.
Okay, very well. Okay, so I just guess it's correct to ask for an applause to our relator here in the room. Thank you very much to all of you, Guido, Willem, and Mark. And my opinion is this has been a very interesting conference with very appreciated speeches. Not easy, not immediate to be understood, but I think that there is a lot of things to be studied and to be integrated in our knowledge for the future. Thank you again, and see you at the next event, maybe by person. Okay? Ciao.
Thank you.
Thank you very much.
Thanks very much.